Well, thank you, Matt. It's wonderful to be here this evening. It's wonderful to see the crowd that we have here tonight. But we should have the crowd that we have here tonight because really thinking about the history of this event, I think we have two of the most remarkable figures in the real estate industry with us tonight, especially when you look at the publicly traded real estate industry. Hamid Moghadam is the chair and CEO of ProLogis. They are by far the global leader in logistics real estate with nearly $90 billion of assets under management. That's 5,100 customers in 19 countries. So they are one of the true global entrepreneurs in our business. Now, Hamid founded the predecessor company to ProLogis, AMB. And if you were listening carefully to the panel that we had before, you'll note his timing in that he led the merger with ProLogis in 2011. And what I remember hearing from that, plus what I've taught students in my class, is it was a few years later when that industry took off. So you can guess what's happened with that stock. Interviewing him tonight will be Bob Steers, who I'm sure you all know is both the founder and CEO of Cohen & Steers, as well as the sponsor of the Steers Center. Cohen & Steers is a leading global investment fund manager in real estate. I view them as one of the first companies to really recognize the potential of the REIT industry in its modern era, given that they were formed, I believe, in 1986, which is exactly when the Tax Act changed to make REITs a more acceptable investment or more attractive investment. Given that our center is named after Bob, you can tell that that investment plan worked well. And we fully appreciate that, too. He's a GU grad. He's a chair of McDonough. Gentlemen, we are really happy to have you here tonight. Come on up to the stage.
Thank you, Ed, and welcome everyone. As you know, Luminaries is really our signature event, and it's one of my favorite nights of the year. Over the years, we've been blessed to have leaders in the real estate industry in their respective property types: retail, multifamily, office. Last year, we talked a lot about data centers. And this year is no exception. We have not only Hamid, but the panel, and I'd like to maybe thank you guys again, to, covering private equity, fund management, development, research in the space by leaders in the space is just tremendously informative and interesting. And it also, in my mind, sets the stage for a very different few minutes to talk about the space from a platform standpoint. Last year when we talked about data centers, it reinforced how important macro trends are in real estate, technology, changing social norms and practices. And obviously I have a bias. I invest mainly in public companies, some of the biggest, most dominant companies in their respective property types. But as was alluded to in the earlier panel, the pace of change in industrial, as an example, has been extraordinary. And I think you can apply that to most types of real estate. David Simon was here a few years ago. He was riding high. And he's still riding pretty high, but retail is a lot more challenging. And so the winners and losers change very rapidly. And in my view, while making money in real estate is challenging and exciting, and there's lots of ways to approach it, from development to fund investing, there's all sorts of ways. But at the same time, and you'll hear shortly, that if you're running a platform, a large public, in this case global company, you have to think in 5- and 10-year increments about macro trends, not just cap rates or economic growth, et cetera. And so I think that sets the stage, if I can move this forward. And this is really just an example of the obvious trends that were mentioned in the earlier panel about winners and losers. So retail's losing, logistics are winning. Technology companies winning. In our real estate universe, we invest in data centers and cell tower companies, and we're very pleased to be a large shareholder in ProLogis. So for those of you who think you know ProLogis as a very successful company, I don't think you really know just how incredible this company is. And so I'm going to run through a few fun facts to set the stage for our discussion this evening. As was mentioned, the firm was founded in 1983, the predecessor company AMB. So Hamid has definitely not been an overnight success. He's been at this a long time. It's a member of the S&P 500 with a $46 billion market capitalization. As Ed mentioned, 87, almost 90 billion under management, 768 million square feet on 4 continents, almost 3,700 tenants, 5,100 buildings. In addition, and this is also not well known, they're in the private capital business, strategic capital, where they manage third-party assets over $37 billion, 9 ventures, with the average size of the venture being about $4.2 billion. And, talk about a massive shift. ProLogis is in the way of about $1.5 trillion of economic value of goods. In the markets that they operate, they represent about 2.8% of GDP and 2% of the world's GDP. And 1 million employees pass through their facilities. So, for me and for Hamid, this is our report card. And I would say straight A's. Over the last 10 years, ProLogis stock has delivered 22% annualized. That's versus about 18% for FTSE Nareit and about 16% for the S&P 500. So with that, I would like to introduce our guest, our luminary, Hamid. Hamid is the chairman and CEO of ProLogis. As has been mentioned, he founded AMB Properties in 1983. He brought it public in 1997, and subsequently, as was mentioned, in 2011 engineered the merger with PLD and has been the CEO and visionary ever since. In addition, in 2018, Harvard Business Review ranked Hamid 17th among the 100 best performing CEOs in the world, not just in real estate. Institutional Investor ranked ProLogis number 1 in environmental, social, and governance metrics in the REIT industry. Pretty impressive. Hamid is a Stanford guy. He's served on the board. He remains active as a board member of Stanford Management, Stanford's Institute for International Studies, and the Graduate Business School Advisory Council. Hamid, would you please join me up here? So I'd like to go a little bit of a different path. I think the prior panel did a great job of talking about current market conditions, particularly here in the U.S. I think we get the joke. There's lots of capital. It's a great place to be right now. But one of the things that sets ProLogis apart, not only from private investors, but other public companies, is you're global, you have incredible scale, and you have development capability, and you're taking on and managing third-party capital. And knowing your company well, that's not an accident. These components have been put together over the years with a mission in mind. So maybe you could start out at a macro level talking about your thoughts and strategy about scale and having all of these capabilities under one roof.
Sure. Bob, first of all, thank you for inviting me to be part of this session. very impressed with all the work you're doing in the real estate area, and I think the name of the center is just great. So, so be nice to me, okay, for the rest of us. So let's talk about all those different elements because they actually tie together. In our business, we're in a very capital-intensive business, and for sure there are times that the public markets are good for financing real estate, and there are times that they just dry up, and you need to rely on private capital to do that. So having a hybrid engine that works on electricity and gas is a good thing, and that's how we started the private capital business. But along the way, we learned a lot of other things that actually help our business model. So let's start with the customer. I think unlike the office business or the apartment business, most of our big customers lease space from us in many, many different locations. So I would say we are more of a customer-focused business than a real estate business. At the end of the day, doing the next, call it even a 1 million square foot deal on the next corner is important, but it's not going to move the needle on a company that actually today, I think we just crossed $100 billion in assets. So, we gotta really bring this platform to serve the needs of these customers around the globe. And unlike apartments where you have one apartment in one city, all our customers are at different ends of the supply chain. So they're moving things all around the world. And to have a credible business, you need to be global. In the other kinds of real estate, I don't think you need to be global. But in industrial, I think to be effective, you need to be global. The problem with being global is that most of this product doesn't exist overseas. So that gets you into the development business. So that's why we're in the development business. We do about a little over $3 billion of development these days per year. And then once you're global and you're in the development business and you're customer-centric, you have to be in private capital because we're a US dollar dividend payer, but we're collecting yen and euro and all kinds of things from a bunch of different people in different locations. And if we didn't have a piece of our business in private capital and 100% of it were on our balance sheet, then we would have a mismatch in terms of asset and liabilities and currency. So the private capital business has become a very good risk mitigation tool for us. Mm-hmm. So all these things kind of hang together to build this platform. And what do I mean by platform? A lot of the tech people use the word platform, and I'm not sure I always know what that means. A platform means that we have the ability to do 4 or 5 things that most real estate companies can't do. And most of it comes from scale. First of all, the lifeblood of our business is cost of capital and cost of running the business. And between our G&A load, which is very low, and our cost of capital, we have somewhere between a 75 and 100 basis point advantage over other people, even in our business, even large companies that are public. So cost of capital is really important. The other thing that scale brings you is the ability to invest in technology. And real estate companies, by and large, can't invest in technology because REITs have to pay out all their earnings, technology is expensive, and you have to have scale to spread this stuff over.
What kind of technology are you talking about?
Well, you need real estate technology, and this is a whole nother, talk that we can have, but real estate historically has thought of technology as automating things that we used to do with pencil and paper. So it's basically accounting systems, lease management systems, databases, et cetera, for reporting and managing the assets. I don't mean that as technology. I mean technology as a revenue-producing endeavor. So data is a very important part of technology, and customer experience is a very important part of technology. In fact, customer experience is a huge part of the logistics business. So if I just landed the ship from Mars here, and I said, okay, there's this business called the logistics real estate business. And here's how it works. You go talk to your customer. You actually get your lawyer to talk to the customer's lawyer. You beat the hell out of each other over a period of a week or so. You sign this document, which nobody ever reads. And then you basically don't talk to your customer until another 5 years when you have to repeat the process all over again. And by the way, in addition to charging the customer rent, you're charging the customer all these pesky little bills that you send them every day. You send them a bill for pest control and for taking care of their roof and taking care of your air conditioning unit. It is nuts. I mean, that is not how you run any other kind of business. So, for example, why are we going to a 60,000 square foot tenant who has one facility and saying, you got to protect us against the roof costs going up or the maintenance or the air conditioning units breaking down? We have almost 800 million square feet of space. We can spread that cost and really reduce that risk for our customers. So we've gone now to essentially a gross lease that we call clear lease. And the customers love it. But we have the scale to spread that risk around. If we had 3 buildings, it would be a very risky proposition. If we depended on mortgages from banks, we couldn't do it because you need a net lease to support the financing. So all of a sudden, scale gives you technology, and scale gives you the ability to service the customers in a very different way. And I can give you lots of examples of that. And the next big opportunity is data. We're in the very early stages of data, but look, there's over 2% of the global economy goes through our buildings, and we know nothing about that. Zero, zippo. So, there's a big opportunity there, and that can help our customers as well.
So moving from pest control, I want to go back to the client here, because I recall vividly 15 years ago you coming in and pitching, moving away from one-off acquisitions or development, and you're talking about the client, and you were talking about IBM or UPS at the time, which was a new concept. And I believe Amazon is about 9%.
3.5.
3.5, okay.
Yeah.
But what is your corporate strategy with respect to who is it you're looking to do business with? You can offer them a global solution, but maybe talk about what's the pitch? What's the solution that you're bringing?
Well, the minimum part of the pitch is that you can lease the best product in the best markets that are hard to be in. We don't have a unique competitive advantage in supplying somebody with a building in St. Louis. I don't want to pick on St. Louis, but I mean, anybody else can go buy land there and build a building. But we have 88 million square feet in LA. I mean, just imagine, the second and third company in our business, I think, is actually smaller than 88 million square feet in total. When you own 88 million square feet in LA, you can add up all the other companies in our business and multiply them by 2, and they're still smaller than that platform. It's impossible to build more stuff in LA. I mean, you have to go Inland Empire East, and you got to go to all kinds of crazy places. We have it in the South Bay. We have it in the Inland Empire. We have it all over. So when you have those unique locations and the properties that the customers want, that really helps them out with business. So that's one value proposition, the best properties. The second value proposition is that we're a reliable partner. We have 23% debt. Anytime you want to do anything, we can write whatever size check you need. We were talking about multi-story buildings earlier. Some of these buildings we build in Japan for our customers are $300, $400, $500 million a piece. They're almost the cost of office buildings. Most people can't write those kinds of checks with regularity. So the balance sheet brings a huge competitive advantage. And also the ability to solve the customer's problems. This happened just in the last year. Walmart and Amazon, we built buildings for them in Mexico. Well, they land in Mexico for the first time in the case of Amazon, and they want a reliable partner that can execute for them and all that. So the reliability and the confidence that our customers have in us is really important. Having said that, if any of these guys who are in the earlier panel have the same kind of building and offer that building at a lower cost, no matter how much of this stuff I argue, they're going to go to their building. So we need to be able to be competitive on cost, but we are bringing all these other advantages. So that sort of gives us a tiebreaker in cases where there is one required.
So can you be competitive on cost at scale?
Oh, absolutely. It's not because we're geniuses. We can borrow capital at 90 basis points over treasuries with a single A balance sheet. And we can run the business for about 40 basis points, really, really. Those two things added together are at least 7,500 basis points inside of anybody else. If you're in a 6% return on capital business and you have 100 basis points advantage between G&A, and you don't have to have gone to Georgetown to be able to figure out how to do that,
Let's talk a little bit about your development strategy. Maybe start out at this multi-level thing that seems everyone wants to know about. So let's get that out of the way.
So multi-level is getting way too much attention. Okay, I think there are.
All right, forget it. We'll move on then.
There are, and by the way, it's sort of people think that we are telling these stories, but of course, you know, newspaper reporters need new things to talk about. So if you're doing something new, 30 of them land in your office and they want to know about the next great thing. We have been in the multi-story business in Japan for 15 years. So there's a lot of experience there. And why does it work in Japan and China? Because land is very expensive and you have to densify. But that's the future of a lot of American cities. Not all American cities. In fact, I would say New York, San Francisco, LA, Seattle, Miami, maybe Chicago. I'm not convinced about Chicago, offer this opportunity. And, but land values have to be at a certain level before you can do them, and then you got to have a big site that's big enough that can accommodate the ramps and all that. So it's not an easy thing to do. I think long term, it can be 10, 15% of our business in the US, but that's talking the next 20 years. Mm-hmm. Our bread and butter is single-story buildings in key markets. So I think it's getting too much press. The other thing that's happening is that this whole last mile business is getting a lot of press. And frankly, there are a lot of people out there that are in the business of leasing substandard buildings and calling it last mile to create some buzz and get a 100 basis point lower cap rate. I think it's going to end up being a bad word in 3 or 4 years. But there's a legitimate need for space that's the functional equivalent of the shopping center, except the goods come out of it with a van to your home instead of you driving your minivan to the store to buy it. So, but it's a functional equivalent of retail real estate, which we are. And by the way, there is no answer to the last mile. If you talk to 10 different companies, they will give you 10 different answers as to what the last mile facility means and how they use it. I'll tell you a little anecdote. UPS rents hotel rooms over Christmas to handle logistics because they can't get enough people and they can't get enough space to handle your parcels at the last minute. So everything is logistics. Retail is logistics. Apartments could be logistics. So, you know, people get very desperate in that time of the year for space, and there isn't enough of it around.
So what are the main drivers of where and when you develop? Is it mainly build to suit? I mean, who's deciding where the last mile is? So
we do. First of all, last mile is a small portion of our overall business. So let's not make it any bigger than that. But I would say every year we're doing about 100 projects, and for about a little over $3 billion last year, for example. Of that 100, roughly 40 are built-to-suit and 60 are spec. Mm-hmm. The built-to-suits are with all our regular customers, by and large. People who can plan their lives a few years ahead because it takes time to deliver that space. Also, people are doing more built-to-suits now because vacancy rates are so low they can't find what they need in the spec market. So built-to-suits have been going up over time. But what we used to decide to build is pretty simple. If you're in the business of building a 50-story office building, it's really, really hard to figure out what demand is. Because for one thing, when you started and dig the foundation, it's going to be 5 years from then before the product is up. You have no idea what the market is like. When we're building a park with 20 buildings in it, and 10 of them have been built, it's very easy to figure out when you need the 11th one, which is where our development is. It's kind of like adding a floor to the office building at a time. We're adding a building. So you can be, your customers are telling you every day where they need space. So let me give you a statistic. We lease 700,000 square feet every day. Every day, 700,000 square feet. I mean, so even if you're a complete dummy, you listen to the customers and they tell you where they need that space. So listening to the customers is the key. That's another advantage of scale.
Having a lot of customers.
Having a lot of customers is a good thing. They taught me at business school a long time ago.
So on the other side of the equation, I think you're well into a program of disposing of non-core assets. Maybe talk about where you are there. By the conversation we had earlier, it sounds like this is a great time to be disposing of non-core assets. So what is a non-core asset to you, and how is that going?
I'm not sure that I'm convinced that we're in the ninth inning and the world is going to blow up. And we can talk about that, but that's a different question. So when we merged with ProLogis, we basically came up with a list of non-strategic assets, and the criteria was this. By the way, this was fresh after the 2008-2009 downturn, 2 years into it. This is in 2011. We went through the entire portfolio, and we said the criteria is, if you don't want it back in 2009 empty because you have a concern about releasing it in that market, it's non-strategic. It's as simple as that. So we put together a list of $14 billion of assets. Yes, that's 14 with a B. And we spent the ensuing 5 years selling all that. So we're done with our non-strategic sales. We picked up a few $100 million with DCT when we bought this other public company last year. And they had a couple $100 million more of non-strategics that we were in the process of disposing. But we have the portfolio we want by and large. And the growth is going to be more addition, not subtraction going forward.
Fair to say, though, you're pleased with the pricing?
Yeah, we've been, but remember, we haven't put that money in our pocket and taken it and bought stuff with it. We bought more industrial buildings. So we've been a buyer, we've been a seller of industrial, and we've been a buyer of industrial in the same market. So we're kind of hedged that way. So I don't think it was great or bad execution.
You mentioned your last acquisition. Maybe talk about how you think about M&A as a strategy for growth.
So the kind of real estate that we are interested is very hard to come by. I mean, I would say we're interested in the top 20-25% of the quality slice, and we're only interested in real estate in big consumption markets. So we're not in a lot of markets that you will find industrial buildings. By the way, I must add, the logistics business we're in is on the consumption side of the supply chain. If you think of the supply chain as from raw materials to a factory, to finished goods in a container, on a ship, to somewhere, the consumption end starts when the container lands somewhere and needs to eventually make its way to your home. Now, whether that's to a store before it goes to your home or to a last mile facility before it goes to your home, we're only interested in the consumption end of the supply chain. The only exception to that is a few buildings we have in the northern border markets of Mexico, where there's a very close tie-in with the U.S. business. But other than that, our holdings are consumption-oriented. So where you're in being close to customers and all that, it's pretty clear where you need to be, and that cuts down the number of target markets. So there's a very small slice of properties that we're interested in. Well, anytime we see a portfolio with a concentration of those kinds of assets, we will aggressively pursue it. So in most cases, you have to dispose of a big chunk of those portfolios. For example, we did a deal with KTR a couple of years ago. Great portfolio, but about 15 to 20% of it we sold because it didn't fit ours. DCT has been more compatible, so we're going to sell about 5% of DCT before it's all done. So the challenge is finding these portfolios that are compatible. What we look for is pretty simple. Whatever premium we pay, we need to get back day one in synergies that are usually G&A. I mean, our G&A actually goes down. Our net G&A goes down every time we buy a company, which is kind of interesting. So I can explain how that works. So we get it back immediately in synergies. And then we really look at revenue synergies, which is how can, by taking this other orange and putting it on our platform, how can we squeeze more juice out of this orange than its previous owner could? And again, it's all the things I talked about. It's technology, it's scale, it's the ability to harvest the data, and lots of other things.
So you mentioned Mexico, and we heard a lot about the domestic market on the previous panel. Maybe if you could share with us both your views and your current strategy about offshore markets, where you are and where you want to be in even more, and maybe talk a little about the differences in the markets and the difference in what tenants expect from you.
Sure. So obviously, U.S. is a mature market. There's a lot of established industrial product out there, and that product is constantly rejuvenated, and people redo their networks and all that. But it's a pretty mature market. It grows at 1.5% to 2% per year in terms of demand, and I would say the UK is probably the same way. Some of the more advanced European countries are that way. But when you go to Mexico, when we entered Mexico City back in 2002, the entire inventory of modern logistics space in Mexico was 40 million square feet. We develop 40 million square feet a year globally. So the product doesn't exist in a lot of these markets. In Brazil, Class A properties doesn't exist. In Eastern Europe, when we went there, those properties didn't exist. So in a lot of these markets, it's a matter of building out the supply chain for the first time. So,
you've mentioned two markets, Mexico and Brazil, which are, Brazil in particular, an emerging market with
risk.
With challenges.
Yeah.
And cycles and geopolitical, et cetera. How do you deal with that?
First of all, we do these in fund management relationships with investors that are knowledgeable about that market, and we set up specific funds or vehicles for doing it. In Mexico, that vehicle is actually a separate public company, which you're an investor in, and in Brazil, it's a private joint venture with an institutional investor. So we mitigate our risk by limiting our own capital exposure to it. That's the first answer. And the second answer is, these markets are volatile. Brazil has been probably the worst market for the last 5 years that we've been in, but it's beginning to be a really good market now. I mean, the amount of activity we've had in the first 2 months of this year are far in excess of what we had all of last year. So it's really coming back. But these markets that have growing middle income levels and an emerging middle class, and are in the steep part of the middle class being built out, are fabulous for our business. Because when consumption goes up to a certain level, once you get to a certain level of affluence, it levels out. You know, you don't consume more when you're wealthy. You know. So we love these markets. We love those emerging markets. But again, we look for the same characteristics. We look for markets that have big population base, growing consumption, and hopefully supply constraints in terms of land. Mexico City, 25 million people. The middle class is emerging. Walmart is the largest private employer in Mexico. I don't know if you knew that. But obviously, if Walmart's there, people are buying stuff, right? So they need a supply chain. So by the way, the credit of our Mexican portfolio is better than our credit in the US because it's all the big multinationals that are actually over there. So
maybe pivot to Asia. Talk about wealth creation, but also challenges, and maybe even touch on China's Belt and Road program. And is that long term? Is that an opportunity for a global company like ProLogis?
Sure. There are basically two big markets. There are three big markets in Asia. There is China, Japan, and India. All the rest are rounding error, literally, if you look at it. So in China, it's a high growth business. You're building out the supply chain of a brand new country almost that didn't really exist 20 years ago in terms of modern warehouses. I think a third of the industrial product in the world is going to get built in China over the next 20 years. So we got to be there. But we're there in a very risk managed way. We're in a partnership where we're 15% and our institutional partner is 85% because you can't hedge the currency in China. Lots of demand, lots of growth. It's all development. There is no acquisition. And the challenge is getting land. You have one seller of land. It's the government. And they don't actually sell it to you. They lease it to you for 50 years. So, and municipalities are land rich and cash poor. And there's no such thing as a property tax. So the way the Chinese municipalities decide to dole out land, it's based on how much registered taxes they can collect. Now the challenge is most companies don't register the capital where they have their warehouse. They register the capital where they have their headquarters. So they don't like industrial. So getting land for industrial in a country that's huge and lots of land is a real challenge. In fact, They have now shortened ground leases for Shanghai and Beijing to 20 years. You tell me how you make money on a 20-year ground lease building an industrial building. You can't. It's just impossible. So China is all about control of land in the key municipalities, but there's lots of demand, and e-commerce is way ahead of us. China, in terms of e-commerce and payments, is way ahead of us. I mean, it's just ridiculous that we still transact in cash and credit cards. And anyway, don't get me going on that. Japan is a very different story. Very mature market, has had a significant industrial base, but Japan has switched from being an export economy to being an import economy. Even all the Japanese firms are making their stuff in China and bringing it into Japan. So the supply chain has changed from a production-oriented supply chain to a consumption-oriented supply chain. The modern inventory of logistics space in Japan is 3 to 4% of the total. So basically, the reason we're building these big buildings is that all these people are moving out of these little buildings into the big floor plate buildings as the market goes more consumption. And sorry, India?
Oh, yeah, right.
We're not in India. We've been in...
Another challenging market.
Yeah, India has historically had the problem of the doing business issues, and the hometown always having a huge advantage. So we've been there. We were there in the 2006-2007 timeframe, but we figured that we couldn't get around the doing business challenges as a public company, and we look at it every couple of years. But it's a tough place to do business.
So are you seeing any impact from the imposition of tariffs with respect to supply chain disruptions or anything?
Not really, because nobody's making permanent plans based on that. And actually the currency depreciation in some of these places has made up for the tariffs, and who knows what the tariffs are. And after a while, people were sitting around waiting for clarity, and I think they've given up and are getting on with their business.
Maybe just circle back to your capital structure for a moment, because cost of capital in a capital-intensive industry is critical. You mentioned your debt's 23%.
Oh, market value, yeah.
Right. So
it's 32% of, Eric actually probably knows better than I do. It's probably 32% of book value, right. Yeah.
So, you know, as we painfully recall in 2008, 2009, when no one knew what asset value was and so forth, and even the most conservatively capitalized REITs all of a sudden had a leverage issue. To what extent is your balance sheet strategy driven by that experience versus, you know, a single A minus is the sweet spot on the curve, you know, for, you know, what's your strategy?
Yeah, good question. So I actually think the sweet spot in the borrowing curve is probably triple B plus, not single A. Single A is probably a little more constrained than. And by the way, we got to be careful not to get upgraded to A1. We keep telling no, I'm that serious. We keep going to the rating agencies and say, guys, we're going to lever up a little bit. Don't upgrade us because we don't want to live within those straitjackets. But we trade inside of A1. We trade better than, A3. We trade better than an A3. So our balance sheet strategy is really important. I learned this in finance course in business school. I'm lying. I never had heard the word maturity management until 2007 and 8.
Yeah.
Okay? So it's not the level of leverage. It's whether you want to give the steering wheel to the banks or you want to hold on to the steering wheel yourself. So our strategy is the level of maturities in each year should be a level that we can pay off by suspending our dividend, so that if there is a maturity crisis, we can just pay it off in that year. So that sort of solves to the level of leverage that we're at today.
Okay.
And by the way, most of our debt is overseas because it's hedging overseas assets in different currencies. Our U.S. debt is actually very little. And we just did the first green bond, actually, in the REIT space.
And what is that?
It's certain banks have to invest, or life companies have to invest as part of their ESG in clean companies, and you get a little bit of a rate break, and they like buying your bonds that way. By the way, one thing that I'm very proud of related to that is that we were just voted the #1 U.S. company of any kind in sustainability in Davos, and #6 globally. So,
Congratulations.
yeah, we got ahead of some
That's
people.
fantastic. So sticking with capital availability, there's a lot in the press about all the so-called dry powder in the private real estate industry, about 300 billion, or a lot of numbers being thrown around. I guess two questions. How does, on one side of the shop, just your core business, how does that affect you in terms of competing for properties? And then on the other side, at strategic capital, are you seeing benefits there?
Yeah, so we can raise infinite amounts of money in our private capital business. I mean, literally.
That sounds like a Sports Illustrated curse kind of
I know,
headline.
It is. But we don't, because there's nothing that we can do with that capital. So we have two big open-end funds, one in Europe, one in the US. They both have multi-$100 million, close to $1 billion queues, and we've stopped taking more money because we don't want people to wait around for a long time to invest their money. So that's not an issue. The issue is finding the appropriate investment opportunities. So we're not the best buyer of going and buying a 3-building complex somewhere that people duke it out to 3.5 cap rate. That's just not our thing. By the way, that wasn't a pun. I wasn't meaning to use Duke. Somebody talked about Duke in the earlier panel.
That's a bad word.
I wasn't trying to be critical of them. But if there's a M&A transaction with an $8-9 billion company, we have competitive advantage. And we did the KTR deal, which was a $6 billion deal, from the day we got the package to the day we closed in 43 days. And we would have done it faster had KTR been able to get their client consents faster. And we got the synergies out of it within the first 3 or 4 months. DCT, we had to wait around for their shareholder approval. We didn't need a shareholder approval because it was too small. But that closed within a couple of months, public company. So the ability to do that is pretty critical. Also, we like assets with a lot of hair. So we buy a lot of stuff that we fix up and broken things. And we're buying a lot of land in urban areas for fleet management, because, and this funny story, we backed into this. We bought a site in San Francisco. We were going to build an industrial building on it, and we were pushing the numbers around and trying to optimize it, and we were going to get a 6% yield on it, and maybe it was going to be worth a 4 cap, and we'd make all this money. Some tech company, which you've heard of and you probably use every day, walked in and said, we need a place to park all our buses where we take our employees from San Francisco to Menlo Park. Right. Now I've told you what the company is. So they took our land, they paved it, they put lighting on it, and they gave us an 11% yield without having to build a building. So all of a sudden, there's a new business. It's called fleet management. You don't know about this. You don't know about this, right? So we're in the fleet management business, and it's been a great business. But seriously, there's a lesson there. I think if you're willing to take some calculated risks and experiment and innovate and listen to your customers, which real estate people tend not to want to do, there are actually interesting business opportunities that come out of that. And I'm convinced that if you're out investing in 26 different kinds of properties, in 26 different kinds of locations, you're not going to have the level of dialogue where you're going to hear that.
Okay, so with all the talk about e-commerce and supply chain, and knowing that historically, I think GDP has been the single most important driver of long-term demand. But with all that's going on in e-commerce and logistics, is it possible for the industrial property type to blast through a recession? Obviously, you wouldn't be unscathed, but typically if an analyst comes in and makes a case based on it's different this time,
yeah, you run for the hills, right? Yeah. So a couple of facts. In the history of industrial real estate in the US, where there's some reliable statistics going back 40 years, there's only been 2 years of negative absorption. 2001 in the post-dot-com decline, and it missed zero by a little bit. I think there was like 20 million feet of negative absorption in that year, in one quarter. So, and then in 2009 and 10, absorption obviously was negative during a period over that. Other than that, we've blown through recessions without any kind of negative situation in terms of demand. So I think the chances of that happening are actually pretty good, particularly given the fact that we're starting today at an effective 5% vacancy in the US markets. When we went into 2008, the vacancy rate was about 8%. So you were already starting quite a bit higher. So yeah, I think there's a chance that we could blow through it. One thing that Eric talked about but didn't quantify as much is that e-commerce, it takes up about 3 times as much space as bricks and mortar. If you want to buy this would use 1 unit of warehouse in a bricks and mortar environment. It would use 3 units of warehouse coming through an e-commerce warehouse because of all the packaging and conveyors and all that kind of stuff. So the shift in the percentage of sales from bricks and mortar to online is a big tailwind to industrial demand. So you had the consumption-driven demand that you talked about that has always been there, right. And then you've got a tailwind. So the question is, how many more percentage points of retail will e-commerce pick up? Today it's about 10, 11% of total retail sales. By the way, Amazon is 46% of that. So they're about 5% of total retail sales. Look, if you talk...
as CEO, you don't anticipate downturns and think about how to defend?
No, I do think about downturns because who knows? I mean, nobody really saw well, actually today a lot of people saw 08 coming, but at the time, very few people saw 08 coming. Look, my strategy for dealing with that is low leverage and spread out maturity. Yeah. Not smart enough to understand these things. And I want to be on offense this time, not on defense. Although we got on offense pretty quickly in 11, so shouldn't be too critical.
So you mentioned Amazon again. I think they are your largest single tenant, albeit no tenant is particularly
top 25 or 19%.
Right. Do you have an Amazon-specific strategy to grow with them, diversify away from them? How do you think about Amazon?
All of that. So first of all, our Amazon-specific strategy is that we don't chase the development projects that they have in areas that are unconstrained because of land. Because you've got 26 developers that are willing to work for the construction margins, and life's too short for us to do that. Where we can really help them is in places where we have good land holdings and they're infill tough markets to get land. So that's where we do
they share their long-term plans with you?
Yeah, they do. We have.
Can you tell us what those are?
No. No, they're great customers. The way we manage our exposure to them is that if we kept every Amazon building that we built, it would be up to 6 or 7%, but we regularly sell the buildings that are in markets that are not constrained. So we built a building for them in Hartford that was actually in a KTR building. We sold that because we're not in that market. So we do a lot more business with them than what we keep in the portfolio.
Mm-hmm. Who's your next largest?
I think it's DHL. It moves around, but yeah, I think it's DHL. It's all the people you would expect to be in that business. Right. By the way, there's only one domestic company in the top 25. Guess who it is? U.S. Postal Service, which I would argue is not domestic, actually, because they bring mail from somewhere else, or junk mail from somewhere else.
Matt, you'll let me know when you have some questions, or
yeah. We have a question on going back to the sustainability piece. So, obviously you mentioned you're a global leader and innovator in the area of sustainability, but in your opinion, will cities be able to meet the carbon emissions reduction goals as set forth?
I don't think so. It will take longer. Unless the whole grid goes, unless the whole transportation sector goes EV, which I think will take some time.
Somewhat related to that, infrastructure and the infrastructure problems facing the U.S. where there's no money. It appears to me the odds of us getting with public-private partnerships to raise money and to improve our aging infrastructure is nowhere near in the future. How does the domestic infrastructure affect you or the supply chain? Are there issues that
It makes close-in location in major metro areas more valuable because
Right. Which was
poor
talked about
infrastructure constrained more means that you can't get stuff from far away. By the way, this is important to talk about. Some people say, well, what are EVs going to do to your business? Okay? And there's a school of thought that says EVs together with solar power and battery storage and autonomous trucks, maybe not fully autonomous, but at least platooned trucks so that you have a locomotive with a bunch of trains behind it, should bring the cost of transportation down to zero. And I believe that. I think the cost of transportation is going to a very small number 20 years from now.
which will continue to drive
Yeah,
the trend?
because solar energy is going to be produced at a lower and lower cost. Battery technology is going to go down in cost and go up in performance. And there are going to be fewer drivers per delivery in some sort of technology. So for sure, I think there's a downward pressure, not in the short term. In the short term, actually, costs are going up because there are a lot of there's a real driver shortage and all that. But in the long term, those costs are coming down. So if the costs are coming down, what are the implications of that for our business? There's a school of thought that says it's really bad because you're going to have these warehouses, 50 miles out of town, and they're going to run the trucks at night, and when there is plenty of infrastructure and get things around. I don't subscribe to that school of thought. I think the most important commodity is time. Amazon has trained people to want immediacy. Now, do you really need everything that you order from Amazon tomorrow? No, but since they give it to you tomorrow, you want it tomorrow, right? So I think time is going to be the driver of logistics locations over time because the number of SKUs are going up. People want more choice than ever before, and they want it right now. And that will drive industrial demand.
So PLD is a recognized leader in ESG, and ESG, I think, is important to everyone's business in this room and in the world, really. Why is it important to your business, and maybe talk about some of the programs that you've implemented? Yeah,
so the way we want to position our company is that we don't really think of ourselves as an industrial real estate company. We think of ourselves as a global property company, and if a global investor wants to buy one stock, we want to be it. So in that way, we got to eliminate all the negatives. And remember, with the almost blow up of ProLogis back in 2008, the old ProLogis, not the new one, so we had a big hole to climb out of. So I think that's why we have a highly rated balance sheet, and that's why ESG is so important. We need to be very, very transparent and understandable to investors. Now, that's the reason now, but these guys have been, how long have you guys been doing governance ratings for REITs? 25 years. We have never not been first, I don't think. The old AMB or whatever. So we've been at this game for a long time. I think, look, I'm a big shareholder of this company. I wanted transparency because I'm not going to be running this place forever, right? But I want that ethos of transparency and people knowing what they're doing. I want good governments to protect my investment in the company. So, look, we always put ourselves in the position of the investors. By the way, that's the way our pay is structured too. 100% of our compensation is equity. My compensation is equity. I make $1 a year.
So you're going to generate 22% a year for the next 10 years?
No.
Okay. So
No.
you mentioned, and
No way.
This will, I guess, have to be the last question. You mentioned that you're not going to be running the company forever. My board asks me about succession planning all the time. I don't know why they ask me that, but how do you think about succession planning? You know, typically in our firm, it's not pick a person. It's a commitment throughout the organization. But how do you think about it?
Yeah, I think what our philosophy is to invest in our people and to give them the skills and the breadth that they need. Now, we're not going to have 26 CEO positions opening up. We're going to have one, but we have, you know, we have lots of senior leadership positions. We have we have 7 people on the executive team. We have 7 divisional presidents that run, for example, the West, the Central, the East, Europe, et cetera. By the way, each one of those companies, if it were an independent REIT, would be the number 2 by a factor of 2 over the current number 2. So these are big businesses. So we have a lot of places where we can develop talent. And we're not really talking about just succession for me, but it's really succession for the entire executive team. And we have very clear plans in place. And we've had that discussion very openly with the board and also a lot of our employees, actually all our employees. I said in an all-hands meeting what my plans were. So.
Fantastic. Hamid, thank you so much for being with us
Great.
this evening.
Happy to be here.